You know the rule, I know the rule, we all know the number one rule of building wealth. You gotta start investing early. Simple, right? So why is it that so many of us wait? Today, we're gonna get into the real reasons why we invest too late, digging into the weird psychology and the real world stuff that just gets in the way.
All right, let's just jump right in. What is going on here? Why is there this giant gap between what we know we're supposed to do and what we, actually get around to doing? And here's the spoiler. It's not because you don't have enough information. It's about this crazy tug-of-war happening inside your brain and in the world around you.
And hey, if you've ever felt that little sting of regret about starting late, you are so not alone. A recent survey found that a full 22% of Americans say their single biggest financial regret is not saving for retirement early enough. That's the number one regret, period.
Okay, so let's break this down, starting with the first huge hurdle, our own minds. It turns out our brains are basically ancient survival machines. They're amazing at keeping us alive right now, but that same wiring can make long-term planning, like investing, feel totally, unnatural.
And the main culprit here is this little cognitive quirk called present bias. You can think of it as the constant battle between me now and me later. Our brain is just hardwired to want the smaller good thing today, like, say, ordering that awesome pizza tonight, over a much bigger, much better reward way off in the future, like a cushy retirement.
Now, what's wild is how early this all starts. The perfect example is the famous Stanford Marshmallow Test. You've probably heard of it. Researchers gave kids a super simple choice. You can have this one marshmallow right now. Or, if you can just wait 15 minutes until I get back, you can have two.
And the results were just fascinating. The kids who were able to delay gratification, the ones who could fight that urge for the immediate reward, they tended to have better outcomes across the board later in life. And that included, you guessed it, way more financial success as adults. Their ability to manage that internal fight paid off for decades.
So the marshmallow test shows us what happens. But why is it so hard? Well, brain science gives us a pretty shocking answer. A neuroscientist discovered that when we think about our future selves, our brain lights up in the same way it does when we think about a total stranger. Let that sink in. Saving for retirement can literally feel like you're just giving your hard-earned cash away to some random person you've never even met.
But it's not just what's happening in our heads. Let's move to the outside world. Because even if you manage to conquer your own brain, you immediately run into a second massive wall. This completely overwhelming maze of financial options that can stop you dead in your tracks. And this leads to a little something called analysis paralysis. The world tells us that having more choices is always a good thing, right? Well, our brains have a limit. When we're faced with way too many options, we get so scared of making the wrong choice that, you guessed it, we end up making no choice at all. Let me tell you about a famous study that has nothing to do with finance, but explains this perfectly. It's called the jam study. Researchers set up a tasting booth in a grocery store. One day, they put out 24 different kinds of jam. On another day, they only put out 6. And here's the kicker. Yeah, more people stopped to look at the big display with all the jams, but the little booth with only 6 jams was 10 times more likely to actually sell some jam. Look at that difference. 31% of people bought from the small selection versus just 3% from the big one. Too much choice didn't help. It paralyzed them. So let's bring that back to investing. In 2002, if you wanted to invest, you had about 30,000 different investment products to choose from. Okay, that's a lot. By 2024, that number has exploded to over 742,000. It's the jam study on steroids. The psychologist Barry Schwartz just hit the nail on the head. He said, at this point, choice no longer liberates, it debilitates. It weakens us. The fear of picking the one wrong fund out of hundreds of thousands feels so massive that doing nothing feels like the only safe move. So what do? Well, experts usually say to either automate it with things like target date funds or just simplify it yourself. Purposely limit your choices to just a few solid, low-cost options. So we've got our brain's short-term thinking, and we've got a paralyzing number of choices. But wait, there's more. There's a third layer, a real double whammy that mixes our deepest emotions with the cold, hard facts of today's economy. Let's talk about fear, specifically something called loss aversion. Study after study has shown that for our brains, the pain of losing $100 feels about twice as strong as the joy of finding $100. It's a huge difference. Our brains are fundamentally built to play defense, to avoid losing at all costs. And this chart, this shows you exactly what that fear looks like in the real world.
This is the VIX index, but most people just call it the market's fear gauge. And you can see these massive spikes during crises, the dot-com bust, 2008. When fear spikes, our loss aversion kicks into high gear, and that's when we make the worst possible decisions, like selling everything at the bottom or just being too scared to ever start.
And look, we have to be real here. For millions of people, this isn't just some mind game. It's harsh, everyday math. When your paycheck hasn't really grown, but the cost of everything else has, when inflation is eating you alive, and you're staring at a mountain of high-interest debt, the whole idea of investing can just feel like a total luxury. The question isn't which fund should I pick, it's where in the world would I find an extra dollar to begin with?
In this data, it tells that story perfectly. Not saving for retirement is the top regret overall, sure, but for younger folks, like millennials, getting into too much credit card debt is right up there. That urgent screaming need to pay down a credit card with 20% interest is fighting a direct battle with the long-term, kind of abstract goal of saving for the future. So, where does this leave us? We've seen all these forces working against us, our own brain chemistry, a dizzying number of choices, and this powerful mix of fear and economic reality. The most important thing now is to flip the problem on its head. The biggest risk isn't making the wrong choice, it's the guaranteed massive cost of making no choice at all. Let's just make the cost of waiting crystal clear, okay? Person A and person B. They both save the exact same amount, $200 a month. The only difference? Person A starts at 25. Person B waits just 10 years and starts at 35. By the time they're both 55, Person A has more than double the money. That 10-year delay costs Person B over $125,000. That right there is the brutal, unforgiving power of time and compound interest.
So what's the solution? Well, it really does start with just knowing this stuff exists. It's about taking small, concrete steps. You fight the future stranger problem by actually visualizing your future self. You beat analysis paralysis by simplifying your choices or just automating everything. Acknowledging these biases and pressures, that's not an excuse to do nothing. It's the playbook you need to finally get in the game.
Which really leaves us with this one last thought. We waste so much energy being terrified of picking the wrong stock or the wrong fund or the wrong time. But as we've just seen, the math doesn't lie. The single most expensive financial decision most of us will ever make is making no decision at all.